Some concepts like liquidity zones are so important that no matter what you trade, whether it's crypto, forex, futures, or stocks, they apply to everyone. And you'd think with such a universal and important concept that more people would know it, right? No. In 2024, the understanding of what liquidity zones even are, the rules and laws around them, as well as the different types you should be looking out for, has been lost behind a wall of buzzwords. It seems like every day there's a new acronym, a new buzzword, a new strategy or tool that gurus are peddling to try to get you to sign up for their course. And it's almost as if they make it more confusing on purpose in hopes that you stick around longer to try to figure it out. But it's just another dead end. However, that changes in this video. Welcome to the complete guide of everything liquidity zones. As always with my videos, much of what you will see today will stretch your current understanding of what you think you know about the markets. You will never see a lot of what I show you today anywhere else on the internet. By the end of this video, it is my promise to you to give you a raw and unsugar-coated understanding of everything liquidity zones. Many of the topics I'm going to show you today can get complex, but I hope to deliver this true understanding to you through the most simply explained way I can. So first, whether you're a beginner or an advanced trader, I don't care. We have to establish what are liquidity zones in 2024. Liquidity zones are a location on a chart where an abnormal amount of orders sit. And the reason I'm using the term abnormal is because there's orders everywhere on a chart, but we as traders like to focus on the areas of the chart where there's likely to be a reaction or move off of. And for those that don't know, why do we call it a liquidity zone? Because we as traders like to visualize liquidity or orders in the market as water. Because of all the orders coming in and out of these zones, it behaves much like a fluid would. And visualizing liquidity zones like water is going to be extremely helpful for later on this video when I talk about the watering hole principle, one of the key laws to liquidity. While this definition is important, obviously it doesn't get you any closer to profitability, but this is where we're going to turn it up a notch and discuss the different types of liquidity zones, which might have you a little confused because how are there different types if they're all the same definition? Now, how the liquidity zones work doesn't change. They all are just abnormal amounts of orders sitting at a specific location, like we said. But why there's different zones is because we use a different technique to draw them. See, price action is always telling a story. Based off certain things that happen in price action, there is common structures that call for a different technique to spot the liquidity zone. Sometimes the story changes, and like right here, we had a massive gap down. This is a shot gap and should draw a zone like this. But down here at the bottom, this was a liquidity formation, and the zone actually sits on top of a consolidation. They're both liquidity levels. They're both where an abnormal amount of orders is currently sitting, and they're both posed to move the market, but we use two different techniques to draw them and spot them. From my research, there are 6 main liquidity structures that I look for. And if you memorize these 6 zones, the odds are no matter what chart you're looking at, you will always be able to find the correct and key zones that you need to see. And remember, these 6 zones are all just abnormal orders stacked at a specific location, but the sequence of candles and structure you will see to spot them and how we draw them varies. While there are theoretically more ways of drawing liquidity levels, I've taken these 6 zones that my professional mentors have taught me from my training in the Bay Area, as I believe they will allow you to spot virtually every liquidity zone on any chart that you're looking at. So what are these 6 zones? Well, before I show you that, we have to talk about the laws and rules of liquidity for these zones to even make sense. The first liquidity law that you must know, which is the most simple, is that a liquidity level above price is thought to be a resistance level and one below price is thought to be a support level. You guys should all know that one. And the second liquidity law states that any after hours gap above a resistance level invalidates that zone, and any after hours gap below a support level invalidates that zone. And what I mean by invalidates is it completely makes that zone go away, and one that we would no longer consider. The reasoning for this is quite simple. Because the market would open above a resistance level where all of those orders are sitting, none of those orders are going to get filled, and the people placing those orders are now going to flip to something closer to price. At a resistance level, there may be a lot of sell orders, but if a market were to gap above it in the after hours, those sell orders are no longer going to get filled, so they're going to attempt to move their order and try to get out at a higher price. More on that when I show you how to draw the zones. Now, the third liquidity law is one of the most controversial ones that I'm going to show you, and it's known as the watering hole principle. There is a common misconception that is believed among many retail traders that the more touches a trend has or a trend line has, the stronger the trend is. And therefore, we should be looking for a trade to bounce off of that in the future, as that's the more likely trade, right? because it's a stronger trend? No. While the trend was strong in the past does not necessarily represent the future, in that because there were so many touches on this liquidity zone, we can actually expect that the next touch is more likely to break through it. But why? Well, it simply has to do with the watering hole principle. The more times a zone is touched, or the longer that price action spends in that zone, the more likely it is that it's going to be broken. And one of the best ways to visualize this is like a watering hole, that the more times animals go to the watering hole and drink, the smaller the watering hole gets, and the more likely it is that the next time they come and drink, they're going to have to go find another hole because that one will have been drained. And perhaps maybe a more clear way of picturing this is with a water bottle and a knife. Picture that this is the resistance level or the liquidity zone above price, and this is the market. Every time the market comes up and takes a big old drink out of the watering hole, well, guess what? You're going to start leaking water. And the more touches you have of that zone, the more it's going to start coming out. And the faster this thing is going to start leaking. And before you know it, the markets come up to it and tag it again. And since there's nothing left, the markets have to, well, go higher. To the next area of liquidity or the next watering hole. The fourth and second to last liquidity law I want you to understand is that diagonal zones, when possible to be drawn, will always be more valid than horizontal zones. Now today, much of what I'm going to show you are horizontal zones. However, a trader must understand that because markets tend to trend and trade diagonally more than horizontally, diagonal zones, when possible, will always be more credible. One of my favorite zones, third deviations, which I'll show you how to draw today, is one of the more common ones and is a diagonal level. Lastly, the fifth and final liquidity law I want you to walk away with today is that price action can move from an abundance of liquidity or a drought or extreme lack of liquidity. Markets don't just move with a lot of volume. They can also move with an extreme low drought of volume. When there is no liquidity, often markets will expand at extremely violent paces until it does find a price where people are willing to step in, which is extremely relevant for things like liquidity grabs and liquidity formations. So now that you have a solid understanding of all the liquidity laws, which again, I'll put up on screen right now, let's talk about how you actually draw these 6 zones with, of course, real world examples. On screen now is the 6 liquidity zones that I believe every trader should know. And again, to recap, that each one of these zones are the exact same fundamentally. They're an abnormal area of orders stacked on a price. The only difference between them is, again, the story that the price action tells that requires us to use a different technique to draw it. So the first zone you'll have to know is the expansion zone. Expansion zones form when a gap plus a candle violates a prior level or range and forms a directional move. We're going to draw from body to body of the first day or first candle after that gap. That is the liquidity level. So here's an example here on AMD. So the first thing we have to do is establish our key levels on a chart. So whenever, and again, you'll be able to do this once you learn how to chart with these 6 zones. But let's say right here, this is a parallel channel. Traditionally, we would say, okay, the bottom here is clearly some sort of support level, and the top is the major resistance level. At the time, without hindsight, this was the most important 2 levels of the market. We were forming a channel, and you had your big zones here. So the next day when we gap underneath of this zone, we violated a major level, this support zone here, and we gapped and pushed in the direction of this. Why would this right here be a liquidity zone? And again, we're going to draw this from body to body of this candle and drag it over. That is our resistance level. If it were to be a gap up, so let's say it gapped up above here and pushed higher, this would be our future support zone. When price comes back down into it, it would be a support zone. But since this went gap down underneath the support and pushed down, this is our future resistance level. Now, why would this create a resistance level? Well, think about it like this. When you gap underneath of a major support zone here, what you're doing is you're going to leave all these orders unfilled. They're not going to be able to trigger because they're not close to the bid and ask. And so what's going to happen is everyone who had buy orders here, they're going to say, screw it. We'll just get out, we'll move the orders, we'll just flip to now selling. So a lot of the times what happens is these guys either get liquidated from starting positions here, or they entirely just want to pack up and move their positions, they give up. And so what happens is a lot of these buyers actually flip to sellers, which pushes this below. Now, for an expansion zone to truly be an expansion zone, you need to have a follow through. This is a hindsight zone. You need to see a follow through in the direction for you to validate any sort of rejection in the future. Why is that? Because if we gap down and then instantly started to pump, well, what does that mean? it means that these guys aren't flipping sides and there isn't really an imbalance to the sell side to actually push it down. They're going to keep buying the dip, and so therefore we can't really use that as some sort of resistance zone. So you watch what happens in the future here, and you'll see that we came into it and rejected off of it immediately several times as well. Here's an example where we wouldn't draw an expansion zone. So say right here, you had some sort of predefined range, some sort of consolidation here. Right here, you gapped above a major resistance level right here. But since there was no follow through in that direction, we can't go here and draw from body to body a support zone because, well, we sold off instantly. We did not have that directional move. Again, there has to be a directional move in the direction of the gap up, or in the case of a gap down, has to be a directional move in the favor of the gap down for it to justify any sort of buy or sell in the future. Now, here's another example of an expansion zone. This one's slightly less obvious, so you need to take note of this stuff. Right here, you have some sort of diagonal support zone here, okay? And it's not going to be, we're not going to draw a wedge, we're not going to do any of that. All we have to know is when is this going to be invalidated to the upside if it does. And what you'll notice is it wasn't until we had this gap up right here, a gap up into and above. Now, when you go back to this image, you'll notice it says this right here. When a gap plus the candle violates a prior low, the gap itself, the after hours move, doesn't have to be clean above the zone. All that has to have is the gap and the candle both violate that major level completely. So in this case, we never closed truly above it. Even though we did gap up, we never truly closed above that. And so what happens here is you had a gap plus the candle. The gap went into the zone, and the candle finally broke that zone. That is an expansion candle still, and this would be where you take your zone and you draw from body to body of that candle, and you slide that over. And you can see when we came down in the future, this caused a massive buy up off of that first touch. And again, since this is a gap up and an expansion after, you would draw this as a support zone for the future. It is a hindsight zone. So even if you get this wrong later in the trend, hopefully you do notice this and can draw a zone for when you can expect a bounce in the future. Here's another example where this wouldn't be an expansion zone. So for example, you have a big gap up right here and a big push, but because it instantly fell back down, this really wouldn't be considered a zone, and we wouldn't draw a body-to-body zone here because, again, you had no follow-through to the upside, so you can't justify why this right here would be a support zone. Now, oftentimes what you will see is that an expansion zone is actually humongous, and it doesn't make for a practical trade idea because when a zone is too big, well, how are we supposed to time this properly? You know, is it a $4 range? It could be a $10 range. We don't know. Sometimes when you gap up above a key resistance level, like right here, then that causes a massive rally. And in that massive rally, it can be hard to judge where the zone actually is. This will come into view better when we talk about pressure levels, but this right here, what you can do is, since we're on the daily here, you can just go down to the hourly or a smaller time frame. And typically what I like to do is highlight the first hourly candle after the gap. This is often where they start to pour into orders. And you can see if we do go over, this was where the bigger reversal actually stemmed from. Now, pressure levels are really unique because this is us trying to spot where an expectation is broken in the market, or where specifically, to a very specific degree, was there a liquidity injection. Now, that's another fancy word, but all it means is where did they actually start to press the buy button, or where did they actually start to press the sell button, which changed expectations. So for example, this graphic right here, let's say we have three kind of bullish looking candles in the market. You have three bottoming wicks. There's a lot of buying pressure in the market. So an expectation is set to buy in the market. There is a buying pressure expectation. What happens when all of a sudden there is a massive red candle after that? There is something that changed right here, because before the expectation was to keep buying, but all of a sudden you have this big red candle. That means the expectation was changed, which means someone was pressing the sell button. Our job is to go in within this candle and find where that sell button was pressed, and that's our zone. So for example, it says whenever the markets form an expectation, it's broken, then we know liquidity is found within this candle. We know there was something that changed in this candle. It's our job to find it. What you want to do is find where an expectation of price action was broken. And this is kind of the hardest part for people to understand this zone, but it gets quite easy once you do it enough. So let's say right here you have a bunch of sell candles in a row. Big red candles right here selling off. The momentum is clearly down. What would you say the expectation is? Sell or buy? Well, in this case, it's continued downside pressure. But all of a sudden, you have this gap up in this break of, the high of this candle and even into this candle right here. That is clearly a break of expectations. So this candle right here kind of broke a lot of the expectations in the market, and therefore it really should be a zone. So what we do for pressure zones is when we identify this candle right here, what we do is outline it from body to body. And then we're going to go down to a smaller time frame. Since I'm on the daily, you can go down to the hourly. And what you want to do is find between these lines what was the most influential candle. In this case right here, it's really only one candle. So we would do it right here. And you just want to adjust your lines to body again, like this. And then you would go down to a smaller time frame. And you can narrow this down more. And what you're trying to find as you narrow this down to smaller and smaller time frames is what was the most influential candle. It's not always the biggest, but the one that either broke the high, the one that shattered the key zone, something like that, or the one that really did get the momentum going. In this case, it was the biggest. This right here, we can stop at the 30. We don't really need to go down to the 5 or anything like that. But this would be our key zone. And you can see in the future, this was where they pressed buy, this exact moment. And what this allows you to do is be very precise in the way that you draw zones. Instead of drawing generic, massive $10, $20 ranges, you can narrow down to a very, very small zone so that you can time your move properly. So here's another example of a pressure level. So right here, we have a market that was steaming up. You had an expectation set. How is the expectation set? Again, it's set by the candles and how they perform. So bottoming wicks, strong high closes, full candles that are all green. Those set an expectation of buying pressure. And so when the expectation is buy, you're seeing bottoming wicks, very small red candles, buy. All this expectation is building to continue to buy. But when you see all of a sudden a massive gap down in a huge push in the opposite direction, this is where a lot of people press sell. This was an expectation breaking candle. And you might ask yourself, well, Raider, isn't this an expansion zone? No, because you did not have a predefined range. There was no range developed here. So right here, this would be an example of a pressure level. So what we would do is we would first outline from body to body of this candle, and then we can actually go down to a smaller time frame and identify the most influential candle. Again, this is the part where a lot of people struggle with. You might want to say, oh, well, it's this big one right here. But that's actually not the case. The most influential is this one right here, because this is where it gapped down and actually pushed below even this gap up right here. So a lot of people piled into this gap up here. You had a push higher, then all of a sudden gap down, and you liquidated all of these. So this is actually where the move stemmed from. Again, it's not always the biggest candle, but what we can do is we went from here, and what we're going to want to do is narrow our candle down, okay? And you want to go down to a smaller time frame. And since I don't get enough data for that, you can actually go back to even smaller and smaller time frames and maybe even get it to something more narrow. But what you'll see is that this is actually the zone that you can expect to see a drop off of. Again, it's not this zone. This was not the zone where you expect a lot of rejection. It was actually this top one right here, because this is what actually broke the expectation. It was the start, the origin of such a big move here. Now, this is where a lot of people get tripped up, but you really need to have a clear expectation that's broken. So, for example, when we look at this chart right here, you can see that there is a predefined range right here. So when you come into a level like this, right, there is an expectation to sell off. This is not an expectation breaking candle, because this was supposed to sell off of here, because you had a previous rejection here. You had a defined range already. So this was supposed to happen. Therefore, it cannot be a pressure level. And you can see in the future, obviously that zone got violated as well. So it was not a pressure level. Out of all the levels, typically this one is the one people struggle with most. Now, before we move on to one of my favorite zones, which is third deviations, I thought I addressed the elephant in the room, which is, what is the best time frame, Raider? Remember, there is no best time frame. A lot of you guys ask this question all over social media. You spam your gurus. You're asking this question, what's the best time frame? What's the best time frame? The time frame you want to use is the time frame that is relevant to your investing ideas or your investing horizon. And have you ever considered, if you are guilty of asking this question of what is the best time frame, that perhaps you don't even know your own trading strategy? Because if you're asking what is the best time frame to trade on, you have no clue what your own investing horizon is. You don't know what your edge is on or how long your edge lasts. That's a major problem. You need to stop trading and figure that out. If you are a long-term investor, get off the 5-minute chart. You shouldn't care about that. But if you're a trader and you haven't quite, found a groove yet, start on the longer time frames and start to narrow down. Find something that works for you. Personally, for me, I like to use the 1 hour for 99% of my charting, and I like to narrow it down. So for example, pressure levels, I would start on the 1 hour or the daily, and I would narrow it down no further than maybe the 10 or 15 minute time frame. Since I trade options, I typically don't care about the 1 minute chart. And that goes for every zone I'm going to show you today. They work on all of them, but just from my perspective, I typically look at the daily and 1 hour most commonly. Now, one of my favorite zones to draw in the market is what's called a third deviation. And it's very common because there's a lot of channels that form in the market. This can be used a ton for very accurate readings as to price targets, where we can expect liquidity to come in, where is liquidity located. Now, a lot of the times in the market, there are what's called mathematical levels. A lot of the times, you'll notice that people use Fibonacci's, these different instruments to calculate where they expect a reversal. Why does that work? Well, it's not that there's necessarily volume there or that there's sitting orders right there ready to be filled, but it's because there's an expectation that that's where volume will come in. Remember, guys, you can't know where orders are or where volume will come in unless if they're on the order book. So for everyone who's saying, oh, there's not enough orders there to move, maybe that person just hasn't pressed buy yet. Maybe they haven't put their order on the books yet. That happens with a lot of trades, is that a lot of volume comes in at a certain location, but it's hidden until then. So that's why mathematical levels are actually pretty cool and really, really helpful. So one of them is the third deviation. Now, all you have to do is draw a parallel channel. Use the parallel channel tool on your charting software. I use TradingView here, so that's what I'm going to use. But what you want to do is find a channel with probably 4 to 5 touches is fine. And you want to try to get as many touches on top and bottom as possible. Now, it's okay to have price bleed through the ends. You don't have to get it perfect. Once you get that, what you want to do is turn on the midline of that channel. Just simply copy this channel to the upside and to the downside. In the middle line of those channels, this line right here is going to be your third deviation to the upside and your third deviation to the downside. And why is it called third deviation? Because each 1/2 channel is 1 deviation. So that's 1, that's 2, and this is 3. So this line right here is your third deviation. And what you'll notice is when price comes down to that general location, again, it's not going to be perfect. You can actually expect some sort of liquidity zone here. So here's another example right here. Again, we can draw a channel here, as many touches on top and bottom as possible. It's okay to have some bleed through. Since technically this hadn't formed a channel yet, this is kind of irrelevant and useless to us. So this is where the channel was formed. So this is what we care about. And so what you can do is draw that channel, get as many touches on top and bottom as possible. And then what you're going to do is you're going to copy this on top, and you're going to copy this on bottom. And you can see that those middle lines act as liquidity zones. So obviously to the bottom, since we are in a trending parallel down, you can expect this to be a bullish reversal area, a support zone. And when you come up here, you can expect this to be some sort of resistance level. Here's a real life example. I actually put this as one of the free charts on the radarreport.com. So if you want to go sign up for free, you can literally see my SPY charts every single week. But this was one of the free charts for October 6th. And I update these every day as they come out typically. So this was an example of this. And what you can see is that I actually drew a deviation channel right here. So what I had was, this was the channel right here. And what I did was I copied this on top, and this right here was the third deviation level as my resistance. This was my resistance level, and you can see we saw a slowdown around there. So far, we've done expansion zones, pressure levels, and third deviations. I think third deviations are extremely easy. Pressure levels are probably the hardest one out of all of these. However, this next one is very interesting because you've probably heard this term a lot: supply and demand zones. This term gets interchangeably mixed up between liquidity zones, order blocks, yada, yada, yada. People like to use this as kind of the jet ski term of watercraft. It is the household name to describe what a zone is. However, there is an actual way to draw these in a traditional sense using volume. The first thing you want to do to spot a quote-unquote supply and demand zone in its truest form is you want to find a red candle with a wick on top that got rejected down with high volume. Once you see that, the zone is simply from top of body to top of wick for a resistance level, or with a big green volume and big green candle up, it's bottom of wick, bottom of body. That would be your zone. So moving to an example on the chart, you have to have volume up for this one because without it, you wouldn't be able to identify these zones. Now right here, you notice that we did come up and you did have a sell-off. The sell-off had higher volume relative to the candles around it or the days around it, and it has that topping wick. So you would draw your zone from top of body to top of wick in this example for a rejection in the future. Here's another example, but to the support side, what you have is a massive volume compared to all the relative strikes right here. This is the highest volume candle in a while here. This would be a support zone from bottom of body to bottom of wick. In this case, this would be your support in the future. Now, supply and demand zones in this traditional sense are my least favorite zones, and I typically do not draw these a lot. They're very situational and require a turnaround with a wick at a top of a trend to be a resistance level, which doesn't really happen all that often, but it does happen and you do need to be aware of it. Now, this next concept is one of my favorite zones, and this one is called liquidity formed versus grab. Yes, I know it's two, but they're so close together and so related that I thought I'd put them together. So what are they and why are they one of the most important zones on this entire list? As a general rule of thumb, liquidity often takes time to build up. If you think about it from a logical standpoint, if I'm a firm that wants to buy $20 billion worth of stock on something, I can't do it all in one day. It's going to take a while. It's going to require the stock to really just sit there and do nothing for me to keep getting filled. And so if liquidity takes time to build, then whenever you see some sort of chop and a breakout come from that, we can actually accurately predict where there would be a reaction in the future, but it's not where you think it is. Whenever you see some sort of major chop in the market and then you see a breakout from that chop, this is actually a big sign of where liquidity is being formed. And what we mean by formed is there's a big position being built around this area. Now, it might not literally be right here, but it's going to be right in here, and where they defend it is pretty easy to spot. So when you have a chop like this, let's say it goes like this, and you see a pump to the upside, where we actually expect to see a liquidity zone is right here on top of that chop. Now, wait a minute. Why would it be on top of the chop if they're technically buying down here, right? Because the stock's going down, they're buying, it goes back up. Going down, they're buying, it goes back up. So why is it that we expect a rejection before it actually comes down and touches where they actually bought? Well, it has to do with what I call castle principle, is that they're building their castle on this level. They're building their big position. And so when invaders come raid their castle, they're going to defend their castle before the invaders get inside their walls. They're not going to let the invaders get inside and then start to fight them. So what you'll see is often a rejection or a reversal off of the top of the chop. Now, one of the most popular zones in trading that I see everywhere on the internet is a fair value gap. This is actually the science behind that, is whenever you see some sort of chop, like you see with the fair value gap, and drop, the zone sits right on bottom here. That is because when they're selling here, they're going to defend their position here right before the chop. But that concept has been around for over 50 years. But that is known as castle principle. Whenever you see that kind of chop, you want to set your zone right on top of the chop. This is a micro one, but it had a big move from it, so it's still a valid chop to put a zone on. Again, here's another example. You have what comes down here, chops. You have a breakaway from this chop. This is a potential zone where you want to watch. And again, it sits right on top of that chop. And again, you need a consolidation or a chop before that move to justify why you put that zone there. Because again, liquidity in these big positions take time to form. So whenever you see a zone like this is where you actually want to be involved in the future because you had that previous chop right here. Boom, huge expansion from there. This is the general area where you can expect selling pressure. So chop, pump up, your zone would sit right on top. Again, castle principle. And when you have a chop and a drop, you would expect your zone to sit right underneath of it for rejection in the future. Now, the other side of this is the liquidity grabs. These are super unique. Remember earlier in the video, I said that markets can move because of an ultra low amount of volume, but also an ultra high or high abundance of volume. Well, liquidity grabs is really capitalizing off of a very low volume area. It's still a price with an abnormal amount of orders, but it's an abnormally small amount of orders. So what is a liquidity grab? Well, a liquidity grab forms when you have a predefined range, such as this one right over here, where you have a chop, but you come out of that breakout and back into the range. Whenever you come up to this area in the future, this upper 2/5 portion of this V-shaped reversal, there was not enough time to form any meaningful liquidity positions. So this is really a lack of orders because you came up, you tagged a specific level, you grabbed liquidity, but all that liquidity is now gone and they didn't have time to build a new position here. So when the markets do come up to it in the future, maybe chop under it, maybe they close right into it, you can actually expect with a very high likelihood that the markets are going to rocket or pivot further off of this level with increased velocity. Now check this example out right here. The requirements for a liquidity grab is you need to have a predefined liquidity range or level like this that goes outside of it and then back in. Since this came outside to the upside and back in, this is an official liquidity grab. What you want to do is you want to mark kind of the upper 2/5 of this area. So really from body to body, the upper 2/5 of that candle right there. This is the liquidity grab area. This is where you can actually expect that if price does go into it, because there is a lack of orders there, it's actually going to slingshot the price and make it go faster. So let's say in the future, I'm long right here and you see it come into a liquidity grab. Well, this is a potential area to hold or even add to your trade, because look at the velocity of this trade increase through this area. So in a sense, this is a liquidity zone that you actually want to bet against because there's a lack of liquidity here. And here's another example here on Uber. You did have some sort of predefined range right here, and what you had was a liquidity grab. Again, liquidity grabs have to be V-shaped reversals. They can't just come up here, chop for a while, and then come back down. It has to be up, maybe 1, 2, 3 candles, and then back down. But this is what a liquidity grab is. Up, down, instantly. What this does is it takes out all these sell orders right here, so that when price returns to it in the future, it's actually a slingshot. It actually makes the velocity of that move go faster because, wait a minute, there's no one here. And so we have to go to where there is someone here. And it's often through that liquidity grab, even if it's by 1 cent, you still expect a break and an increase of velocity through that level. So you can see right here, again, you would mark out kind of the upper 2/5 of this area. Now, since this is a gap, what you could do is just say, hey, look, the gap of this is, like this. I'm going to take the upper 2/5 of this gap somewhere right here. So when you get up to here, you can actually expect that upon gapping above it or something like that, you can expect an increase in velocity. And what you see here is, look at this. You slow, came into this, boom, slingshot. It just instantly increased the velocity of the trade. Again, here's another example. You have a predefined range here, and we're going to use this high right here. This was the liquidity grab, the fake out. You had a predefined range. You come up, you fake out, you come back down. We're going to mark out that upper 2/5 area of that candle, and we're going to say, look, if we come back up into this in the future, we can expect some sort of violent squeeze off of this because this is a lack of orders. It grabbed all the sell orders from here, and so there's nothing left there. And so you can see, again, the velocity of this trade picked up as soon as it hit that level. Although less common, this is still relevant to the downside. You can see right here, we had a liquidation. We call it a max pain move. To the upside, it's a liquidity grab. It's still the same thing. Liquidity grab to the downside. Right here was that liquidity grab. You had predefined range. Of course, right here, though, testing our knowledge, you would expect this to be a liquidity zone on top here, castle principle. But right here would be your liquidity grab. You mark out the bottom 2/5 of that level, and that would be where you could expect velocity to increase in the future. Now you can see, because of how buying and selling bring different mechanics to the market, it is a little less common and a little more rough, but you can see how the velocity of this move did increase off of this zone. Now, knowing the difference between a lack of orders on a zone and an abundance of orders on a zone between the liquidity formed and the grab is super, super important, because liquidity grabs we're actually betting against. We're betting for a break rather than the respecting of that level that you would traditionally think of. Oh, well, Raider, it's a high. That means it's a resistance level. No. Just because something's a high or was rejected in the past does not mean that it will be in the future. And so if you understand that principle, that liquidity doesn't have enough time to form, then it's actually a good place to add to your trade or even maybe take an entirely new one to begin with. Now, the sixth and final zone is going to be shot gaps. This is pretty straightforward. Whenever you see a stock that's booming, going really, really well, or dumping and going really, really bad, and then all of a sudden you get a massive gap that just completely takes everything by surprise. You're at the high here, all of a sudden, boom, massive gap down and push in that direction. That means the liquidity actually sits right here. Now, in a lot of cases, you actually can make this an expansion zone too, that, hey, this right here would be an expansion zone right down here. But also the gap fill is also a major liquidity zone. Why is that? Everyone right before the close was placing all these orders right here. And so when all of a sudden, boom, you have this massive gap down, those orders aren't going to get filled. And a lot of them are actually going to stay there because they're buy orders. And so when you do come up to that level in the future, you actually can expect some sort of major rejection off of that. Because again, remember our first liquidity law that a zone above price is considered a resistance level. Now you can see right here, Lulu, you were chopping kind of here, boom, you had this very explosive move into earnings. Everything was looking positive, everything was looking good, and then all of a sudden, you just absolutely got dumped on. What often causes shot gaps is some sort of news, earnings, things like that. And so what you can actually do is draw a liquidity zone here, and that is your future resistance level. Now, you can also say, hey, you know what? Because this broke this predefined range right here, this is also a expansion zone. So you would say that the body to body is the future liquidity zone. You come down, first touch here, you start to reject off of it. Because again, you gap below and violated this major support level right here of this channel. So you would draw a body to body. Now, to be very clear, that shot gaps have to go in the opposite direction of where the trend was initially going. So for example, Eli Lilly here was absolutely rocketing to the upside. When you have a gap on earnings like this is not a shot gap. While it can be considered an expansion zone, this is not really considered a shot gap. And the last example here is on Meta. So right here, you kind of had a nice little flag pullback. Everything was going good though. There wasn't a huge trend to the downside. You were consolidating, and then all of a sudden, you just absolutely tanked 26% in one day. That is obviously warranting of a shot gap. What you do is outline from body to body of the candle before the gap, in case you haven't caught that by now, before the gap. And then that's your zone in the future. Just the candle right before, whether it's green, red, we don't care. Just the candle before the gap is your zone. Now, those are the 6 major liquidity zones. So while there is an honorable mention, put and call walls, that I did not put on this list because I had made an extensive video, one of the best performing videos on my channel to date. You guys should definitely go watch this. This is one of the most important liquidity levels of all time. It's based off the options market, the open interest, and it's called call and put walls. I promise you will see stuff in that video that you will never see anywhere else. Now that I've showed you all the examples of these zones, we have one major problem, and that is that all this data is, well, cherry picked. There's no other way to put it. I went on a chart and I tried to find good examples that fit my narrative to explain the lesson better. So what better way to get around this hindsight bias and to actually see live examples that I've cataloged in the radar report to see how I use these zones in real time. So let's look at my report from, well, the week of December 1st. Now, if you guys don't know already, the radar report is where I catalog my professional research and trade ideas. I publish these every single week from not just a weekly perspective, but also a monthly perspective. I post all the seasonal data, monthly reports, all of that jazz for any style of investing. And additionally, like a ton of tools that I've custom built myself to fit my trading perspective. But one of my most recent reports actually was my December 1st one. And I believe that I used a lot of these zones that I discussed with you guys today on this report. So let's check it out to build, again, trade ideas. Now, this report was really thorough. It talked a lot about some different themes, things like that. But here is another example of zones being used within my charting ideas. So this was CAT right here, CAT. And what I had done here was I had drawn a parallel channel. This is the midline of that parallel channel. And then I drew a deviation out. And I said, look, if we come down to this deviation, it's likely to have some sort of bounce. And then we expect our entry to be back up into this 408 zone to any gap up over 406. If you actually go look at the CAT chart, you can see what happened to price action here. And, well, check this out. We had price bounce off that initial zone, which was great. But where everything kind of tumbled over was, of course, you had a massive flush through that zone. I actually did take entry since we did gap up and over this. However, it was only 1/3 of my position size as outlined on the report. And well, that one just didn't work out. But again, this is where you can expect some sort of bottoming sequence to commence. The next trade was really juicy and quite a big one at that, was buying 12-13 calls on, well, ENPH. What I had done here was draw a channel. Instead of doing the third deviation, I just simply said, look, if we come up, we gap above this channel. Again, I always use the term gap up. You can see right here for a gap up to occur. And that's really what you try to look for. And then the dip buy area right down here, this kind of goes off the idea of a shot gap. While shot gaps are on a bigger spectrum, on a tinier spectrum, typically gap fills often are liquidity levels. And what you can find right here is, well, upon a gap fill, the candle right before gap fill is typically a liquidity level. So I said somewhere within this gap, we could see some sort of reversal down into $68. If we go to ENPH, this was one of my bigger trades. Now you'll notice here that we came down into around 69. We didn't quite make it all the way down here. But where the key trigger was guess what? A gap up. We gapped up and over that golden pivot level. That is an indication to me that I need to long. And that's often what causes that trigger. Again, if you have an intraday move like this with no gap up, it's often a fake out. You need gap ups to invalidate that selling pressure zone and truly lift the pressure off of the market. That is such a huge principle. Now here is a really, really cool one. So this is not only utilizing some of the call and put walls that I discussed in my previous video, but also if you look here, this is a liquidity grab. Check this out. So we had a kind of range that formed here, whether you look at it from a diagonal perspective or a horizontal one, either way, this is a liquidity grab. You have a V-shaped reversal. After hours move up, instant dump it open. This right here is what we talked about. It's a liquidity void at 512. And technology was expected to expand. Basically, the major thesis of this week here was that technology was expected to outperform and that we really expected, SPY to start to lag and QQQ to start to outperform. You can screenshot this and read it if you want. But this right here is what we expected. And if you go and you look at tech right now, you can actually see this play out in real time. That was a liquidity grab. And what happened was, when we gapped up into that void, remember it's a void of liquidity, you saw the pace of selling instantly increase. Now, was this move entirely generated from this wick alone? No, but it fit the narrative and the seasonal expectations that, wait a minute, technology is expected to outperform this week. We also have huge rotations, early signs of rotations coming up into these kind of technology names, these things like this. So it was building context around why we should validate that zone. And again, I've talked about this on my channel before about how to actually validate price action. Price action alone is a complete lie, but you need some sort of validation to price action to justify the strength that you see in the price action. So for example, a seasonal chart, rotation, some sort of option flow to pair with it, things like that, because there are thousands of head and shoulders, thousands of patterns at any given moment. How do you know that the one you're looking at right now is going to work? You need some sort of information outside the charts to verify that. And so that's kind of, that's called building context. That's kind of how I did there. So that was kind of a technical point was I said, hey, look, this is a liquidity void. If we go up to that, it's likely to slingshot QQQ higher, right? That it gives that feel necessary. And that's, again, using this liquidity grab principle in real time. I mean, I post these before the week start. These are all cataloged for that. Now, again, right here, here's another example. So this was my biggest trade of the week, which was AVGO. Now, if we go back to the AVGO trade, this was massive. I mean, I got nearly 300, 400% on this. I did not wait till this day, GG, but I did sell most of my position right here in the opening of that 174, 175 on the 5th of December. But with this right here, you had what was pretty basic, and it was right here you had some sort of chop here, and then you had a massive flush, right? And so my thinking is, well, wait a minute, right? That if you are right here, if the liquidity zone, if the flush happened right here, this is castle principle, that you have the zone sit right on bottom, or the top of this right candle, bottom of this consolidation. If you gap above that, what you're saying is you're now gapping above the biggest selling liquidity level, right? The liquidity zone. And then that would trigger some sort of move. And again, I always talk about it. I say a gap up into or above the golden zone is necessary to justify an entry given the current weakness over the last 2 weeks. I said, look, we have flow to support it. We have seasonals to say that they're going to outperform. We need to talk about how we can enter this, right? We have the right data to suggest a bullish idea. How do we enter within that bullish idea? And that comes from right here, AVGO, that we had this zone, this technical zone. I outlined that. The point of charting is to outline where the proper risk that you've outlined is best taken, right? We've identified the upside as the best risk to reward, but where is that opportunity going to be best for us? And you can see right here, as soon as you gapped into and above that zone, boom, you had that expansion. If this made this move intraday, you wouldn't have been able to get that big move that we saw. So that is a huge component of why you see that kind of stuff there. So again, big move here. And again, you can kind of see this here, that you kind of had a liquidity grab here, right? You had a predetermined range. You kind of had a liquidity grab here. It was V-shaped reversal, came back on top of this range. Not the cleanest example. But again, any V-shaped reversal like that, you have to take note and say, well, wait a second. If you do come up into this top 2/5 area, start to chop or whatever, that's likely going to slingshot price again. So that's exactly what happened. Moving on, you actually have INTC. Now, INTC, this example had news, so I never actually entered this trade. But you can see this was using some option levels. It had an ascending call wall. If you don't know what that is, go watch my previous video. Like I said, again, it's a liquidity attraction. So the attraction was to 25. INTC got there, but then news hit this morning, the CEO stepped down or whatever, and it just completely collapsed. So because it went to target one, it gapped like 3% after hours, which was way more than I was even anticipating. So I never actually entered the trade. The risk to reward wasn't great, but the news just completely took it over. So that one was invalid, but cool principles nonetheless. So here's another example. Again, Google. This is betting on if you gap above the resistance level, that you can expect some sort of expansion, right? That would draw an expansion zone, but the trade isn't waiting for the expansion zone and then playing off the bounce of it. It's just simply saying that that would likely expand off of that. So if we look at Google here, this was one example here. You did not actually gap up, but again, you came into this level, you started to pump with a lot of velocity, and that's really what got it going. The next one was actually CAR. This was a good one as well. Again, what I did was I outlined where there was a predetermined range and I identified the kind of area, which happened to be right there, right before that gap up, right there. I felt like this was the liquidity zone. And again, that's very common to see the candle right before, from body to body, to be the liquidity zone before a major gap up like that. as that's what's holding the level. And I said, look, any gap down underneath of this, we had a hedge order come in. This is calls, and it's likely to make stock flush. Market makers are likely going to start selling stock, and that's what exactly happened here. So right here, if I can turn it up on the daily here, you actually had this kind of gap down here. So you had a slight little gap down and flush. Again, that's all you need to justify. It doesn't need to be a gap down clean under. It just needs to be a gap plus the candle that violates the major level or the predetermined we had a diagonal range here that was pretty consistent. So that's what I did there. So I played this one, really good trade there as well. And let's take a look at this week's trades as well. This is the week of December 8th, which is of course the week of me filming this right now. It is currently Monday or Tuesday. I forget what day it is, but either way, you have this right here, which is TTD. This had, again, context to support some sort of bearish idea here. What I wanted to see was any sort of gap down below. And again, I always say gap downs or gap ups most of the time because that's what's ultimately needed for some sort of expansion. Intraday moves are often fake outs. You need some sort of expansion. Now, can you guess what zone this is? Well, wait a minute. You have a chop and a pump. So the key pivot level would actually sit right on top, right? That's what we talked about, that it would sit right on top of this zone. And so that's the liquidity level I was betting on, that, hey, if you gap down below this again in the future, then it's likely to actually flush. And so if we can go look at TTD right now, well, wait a minute, look at that, right? So you gap down right underneath of that. Of course, you also gap down below this level right here, and you absolutely flush. So that was kind of the idea there. The next one was XLU. So XLU never got an entry, but this one right here, again, never gapped above the golden zone. But you can see, because we didn't gap up, we didn't really have any real buying pressure. But if you go and look how I drew this green dip buy zone right here, guess what? You had a chop and then a pump. Guess where the liquidity would sit? Right on top of the chop, like that. See, that's how exactly I got this zone. So in real time, I'm displaying where you can expect to slow down, things like that. Now, I didn't actually buy this zone because of the law of momentum, but this is super, super crucial. Way too much selling momentum to justify any sort of buying into this zone. Now going down, we also had an idea in biotech, XBI and ALNY. So if we actually go look at biotech, XBI, you can actually see right here that we're actually betting on some sort of expansion, that because we have a liquidity grab to the upside, I'm actually betting that, since we're chopping in the middle here, that any expansion higher above this golden zone, I'm going to hold this and bet that it starts to accelerate above and into that 105 level. So I'm still bullish this name. I have not entered this one, but again, this is the same idea. If we gap up into or above this 99.76, I'm taking entry in that. Now the next one, ALNY, super good example of another liquidity principle we've talked about, a law, which is, of course, the watering hole principle. We have tagged this zone so many times. Now, again, what is the justification for playing this? We keep tagging it. We keep tagging it. It could never stop. You're right. But where we can expect it to break is actually due to a gap up into or over that zone. Once you gap up above it, it's likely to cause a major reaction. So that's what we're going to be playing on ALNY. Again, when you have these kind of chopping things, this is often a sign that firms are offloading shares or someone's getting in new, and that's an area where you want to try to be involved. That compression, that crush of volatility to then play the expansion of volatility. So I have a squeeze level right here. Now, why would I have that? I have that there because this right here is where kind of that massive shorting began. If you look at this, this is actually the expansion zone. So this is the expansion zone. So we violated kind of this key range right here. We violated that range. We gapped down underneath of it. That makes this the expansion zone. Since we are chopping under it, watering hole principle states, right? The more you chop at a zone or the more times you touch it, you're actually likely to break through it. So while I didn't highlight this zone, I highlighted it as a squeeze zone because since we are already draining it, if we gap up into it, guess what? There's nothing here left. And since so many people shorted here, they're going to come cover or they're going to add fuel to it, and it's likely to expand with a lot of aggression. So that's my example there. Again, just using some technical principles that we've already talked about today. The next trade, which was the trade of the week, was solar. FSLR. FSLR and ENPH, solars in general, were the trade of the week. I had already been holding ENPH, so that one rocketed, did really well. But FSLR, this one, again, all the zone was this right here, that we had kind of some sort of chop. Now the golden zone right here was in this case right where it started to break down from this low here. I kind of put this zone right here. You could have put it right here down below because that would have been below the chop and that would have fit the narrative a little better. But regardless, I put it right there. I just thought it was the proper call, the 1975. There was also some flow to warrant that level. So you can see right here that we had, guess what? a gap up into and above that zone, which warranted calls for me. So because we gapped up and the candle plus the gap broke this level, that was enough for me to actually take longs, that we were in this level. So I did take longs on this. I think I bought a little towards the top here, but caught this next candle here. So still in FSLR, I think it was a decent trade. Now, hopefully from the 2 reports that I showed you, you would have seen that literally every zone was a variation of what I showed you today. From the liquidity grab being the justification for QQQ to break out, or the other things like the chop and the zone sits on top. So guess what? If we gap down below it, if we gap down below the biggest liquidity level, it's likely that they're then going to switch to now selling, and that zone becomes invalidated. That was a liquidity law we talked about. Now, the last 2 things I'm going to talk about in this video are first, momentum, and second, debunking a lot of the tools and common levels you will see on the internet. So first, let me talk about momentum, because while it's not really a liquidity law, momentum is one of the most important concepts you can understand with trading. And I put this concept at the end so the people impatient enough to watch would purposely miss this content, because it is absolutely vital and essential to actually making sense of zones. On screen now, I'm going to put a graphic, and this shows the different kind of attitudes of momentum and what we should be as traders, whether dip buyers, whether not touching it, things like that. What you guys have to understand is that momentum trumps everything. It actually invalidates zones completely. If there's enough momentum into a zone, then that zone is likely to just be broken anyways, and it's not likely to cause a very good reaction for us traders to take. Earlier in this video, I told you to really picture liquidity zones like fluid, like water, because when you see things like momentum, it makes it make a whole lot more sense. Think about it like this, that if I, drop a huge basketball from the top of a helicopter down into the ocean, because of how high it was, it's going to go down into the water a little bit. It's going to go down into that support zone, but eventually it's going to start coming back up to the surface. How hard I throw it down determines how deep it goes past that support zone. Support zones don't always mean bounce. They could just mean a slowdown in selling pressure. And that right there is why momentum trumps everything. If momentum is too great into a zone, we should not be trading against it. Like I showed you with the XLU trade, that had a massive dump into that support zone. Was it likely to bounce? Sure, it was likely to slow down, but not bounce and reverse to like how we wanted it. So think of zones as more of checkpoints to check where momentum is at. And if it's slow enough, then it's good and probably decent for a bounce trade. But if momentum is fast enough, that checkpoint is no good and you're going to have to wait till the next one. Or at least until it slows down and comes back to the surface like the basketball when you throw it down into the water. A lot of you make the mistake of trying to just focus on where to buy, when in reality, the proper question is when to buy. Timing is everything. If you're focusing too much on where, believe me, if you like it at $100, you'll love it at $50. And if you focus on when, then it doesn't matter what price it's at. It's just when that setup is good, when that momentum has slowed down, and when can you actually justify strength and see it. Stop worrying so much about where, but rather when and what that looks like, because the when will justify the where. The where doesn't necessarily justify the when. And now finally, time to debunk some big themes that I think I've seen all over the trading community. First of all, dark pools. Everyone and their mom talks about dark pool levels. What do I think about them? Well, they're an absolute scam. Now, why do I say that? That's a bold statement. Think about it like this. The purpose of a dark pool is quite literally not to move the market. So when you see a dark pool level and you go, oh wait, look, it moved the market, that is just fundamentally not true. The whole purpose of a dark pool is to not move the markets. It's to pair big orders together so that they don't influence the market. But the softwares won't tell you that. They'll tell you the perspective of, oh, it's people that are secret bankers in the dark doing business. No, their orders are meant to not move the markets. That's why people go through dark pools. And on that same note, you can throw a dart at any price and it will be a dark pool level. Any even number on SPY, 600, 610, 620 will be a dark pool level. Guess what? That's not that informative. As I outlined again in my options video about how price is a lie, which again, you should go watch, I outlined how you need to know options walls because that gives you not only a where you can short, but by when. Dark pools do not give you a when like options do. With options, we knew exactly when the market makers were likely to balance these big levels because there's an expiration to it. Versus dark pools, there's no expiration. The level can sit there for 30 years if it wants to. So in my personal opinion, I would stay away from using dark pool levels. They offer little edge for as complex of its topic as they try to make it seem. Secondly, bookmap. So many people use bookmap in the markets. While I don't think it's the worst tool to use, I think it's somewhat of a gimmick. All Bookmap shows is really the visualization of level 2 and kind of the order book. But why this is somewhat of a lie is because in 2024, with such algorithmic trading spreading across the market, of course, there's so many fake orders, so many algorithmic orders that are spammed, that are false, that may get retracted instantly. We see this all the time. If you've ever been a level 2 tape reader, you see iceberg orders, you see fake orders, you see orders spammed but never go through, things like that. High frequency trading really dominated the early 2000s, and high frequency traders were just making millions off scalping and exploiting orders from big funds. While that still does happen sometimes today, in general, that kind of edge is not really what it used to be. So algorithms have had to evolve and try to be more elusive in how they do their business. It's just like how I said earlier about the mathematical levels, that sometimes there are levels in the market where we can expect actually volume to come in, that we can actually predict when there will be an increase of volume without even seeing it on the chart. So in my opinion, I think Bookmap is an all right tool, but I personally do not use it, and I've done very, very well without it. I have used it before just to try it out, but with the bubbles and all that other stuff, I didn't think it was quite relevant. The best representation of a market is the Japanese candle. And if you have just a bunch of bubbles on your chart, I think that's a little bit more confusing than just understanding how the market works from a logical and mechanical perspective. And finally, one of the biggest myths that I want to debunk is actually trading with price action zones alone. You cannot, I repeat, you cannot make money in trading by just trading with price action alone. Now, I know that statement is going to get everyone fired up, but it's true. Because if you trade with just price action alone, you are going to struggle to know what is actually going to work out with edge. I've used this analogy in previous videos, but I've said that in the markets, there are hundreds of thousands of bullish setups, hundreds of thousands of head and shoulders, of patterns, of wedges, all at the same time on any asset, on any given time frame. There's hundreds of thousands, maybe even millions of the setup you're looking at right now, ready to long, that are exact duplicates. But what makes that setup you're looking at a good long? Is it the price action? No. What makes that price action good is that you have the means to justify why that strength is valid. For example, we could see the same head and shoulders pattern on a growth stock and a defensive stock. And let's say it was October. Well, if you're looking at the two different ones, they're the exact same candles, literally wicks, candles, everything is the exact same. Which one do you long? Well, out of the October bottom, seasonals would prefer growth. So you would want to long the growth name because, of course, firms are going to prefer to rotate into growth as you come into that November, December period. But if you didn't know that and you longed the defensive name, you would have gotten cooked. It wouldn't have broken out really. So what justifies price action is what you have behind the scenes that you lead up to the price charts to validate the strength. That's what I call a funnel. Traders have to have really good funnels to get you to a price chart. For example, one of my most profitable strategies has been option flow. One of my perspectives in that a lot of the times I'll see an option flow order that meets the criteria of a certain stock, of a certain seasonal that I'm looking at, things like that, and that leads me to a chart. But by scanning charts first, you're actually doing yourself a disservice because you want to filter out all of those exact same setups to find the ones that actually have data to back them. So when it comes to zones and how I implement them into my trading, they are just a means to say, hey, I already have this idea, but here's where I think the idea will be executed best based off of this chart. That is literally the purpose of charting. It is not to say, oh, look, there's a zone here. That means it's a trade. No, because you need to have edge behind that idea, behind that price action to justify why it would bounce there and now. Why would it bounce now? Anyway, guys, that is my complete guide of price action. Hopefully you learned something over the course of this last hour. And of course, if you want to see more about my trading, my perspective, and my professional research, ideas, things like that, you can sign up for the Radar Report. I mean, I've put all my blood, sweat, and tears into this to provide an actual perspective for investors. In today's world, I am sick of all these gurus, of all these people spreading all this misinformation online, as well as just in general, the toxicity in the trading community. I want to offer something genuine, something unique, something fresh, and something that actually provides you tremendous value. And so I believe I can do that, providing you my perspective in the markets. You'll see all my trades, entries, things like that, including live data tools that I've custom built for myself to share with you and show you how I trade. What is the means of me going about and trading? And I think you will be very impressed by the work that I do. I don't think you'll see it anywhere else. And I like to pat myself on the back sometimes and say, you know what, I do pretty damn well in the reports, which hopefully you guys take some inspiration from and maybe even take a few trades from. But if you found value in this video, please consider sticking around. Whether you follow, subscribe or not, I don't care. But whenever this video comes up and you're recommended, just click it, just watch it, give it a watch, do yourself a favor, take notes, get some value out of this. Have a great day, guys. Bye-bye.